Once again, thanks for joining us. Holly Shields here for Kalkine Media. Let's talk inventory turnover ratio. Inventory turnover ratio is an accounting ratio that establishes a relationship between revenue cost and the average inventory carried during an accounting period. It is an accounting ratio and is also commonly known as stock turnover ratio. The inventory turnover ratio is an important ratio for businesses as it explains how much stock carried by them is converted into sales. Simply put, the ratio describes the number of times the company sells its inventory during a given period. The ratio is also becoming increasingly popular due to its importance in the e-commerce sector. Additionally, retail firms also use the ratio to keep a tab on their businesses. Turnover management is an essential step towards warehouse management. So, how is the ratio calculated? The first step for calculation is finding a time frame to measure the inventory turnover ratio. Now, one must calculate the cost of goods sold. This requires the stock count of the inventory at the beginning and the end of the month. The formula that can be used to find the COGS is beginning inventory cost plus purchases minus ending inventory cost. COGS or COGS can also represent revenue from operations, which refers to sales. Thus, sales can also be used in the place of COGS to calculate inventory turnover ratio. Therefore, the cost of sales is the actual value of inventory converted to sales. The second part of the formula involves finding out average inventory, which can be calculated using a simple formula. This involves adding the inventory stock at the beginning and at the end of the respective cycle, then dividing it by 2. The number obtained from this formula of inventory turnover ratio depicts the number of times the inventory is turned over within the time frame for which inventory change is measured. So, how about an example? Consider a firm that wants to calculate inventory turnover ratio for the period of 1 month. The firm has the following information. Total cost of goods at the starting of the month is $108,000, which is equal to $800,000. This is known as the beginning inventory of the month. It's a good practice for companies to take inventory count by the end of the month again. Thus, the total cost at the end of the month is 100 by 7,000, equal to 700,000. This is known as the ending inventory of the month. Now, the invoices suggest that a total of 7,700 units of goods were purchased during the period of 1 month at a rate of $100 per unit. This amounts to a total of $770,000. COGS can be calculated as beginning inventory cost, $800,000, plus purchases, $770,000, minus ending inventory cost, $700,000. This is equal to $870,000. Therefore, the cost of goods sold is $870,000. Average inventory cost can be calculated simply by taking the average of beginning and ending inventory. Thus, average inventory cost is the total inventory turnover, which can be calculated by dividing COGS by average inventory cost. This gives the value of $870,000 by $750,000, which is 1.16. This means that the company turns in the inventory once every month. So, what does the ratio signify? The inventory turns ratio signifies how many times the inventory is turned in with a specific period, which was 1 month in the above case. This ratio can be compared with competitor firms to understand better how a company is performing. Suppose that a competitor of the firm has an inventory turns ratio of 2.5. Then clearly the other firm is selling more products than the concerned firm. However, it's important to note that this ratio alone cannot deem a business as efficient or worse than its competitors. Other metrics may turn out to be higher for a firm with a lower inventory ratio. Additionally, inventory turns ratio can be used to calculate how many days it takes for a firm to finish its inventory. This can simply be achieved by dividing 365 by the inventory turnover ratio. In the above case, it would take 314 days for the firm to completely clear its inventory. So why is the inventory turnover ratio important? A high inventory turnover ratio signifies how successful a company is in turning stock into sales. It also suggests that the company is actively partaking in inventory control measures, coupled with a strong sales policy. Low turnover ratio points to a lack of demand for the company's goods. It may also hint at outdated products being sold by the company. This could mean a piling up of stocks in the future for the company. Moreover, the quality of a good may deteriorate over time as it is kept in storage. An ideal inventory ratio for a company can vary depending on the size and type of company that it is. However, a good policy for a company to clean out its inventory 12 to 13 times a year. So what are the limitations of this ratio? Despite its many advantages, the inventory turns ratio comes with certain limitations too. The time taken by a company to sell its inventory can vary greatly depending on the type of product that is sold. Thus, having a fair idea about the inventory turns for the respective industry can give a better idea about how well the business is doing. Consider the case of fast-moving goods, wherein it's easier for firms to make sales as goods are lower priced and come with a shelf life. Consequently, if retail chains selling everyday supplies has a high inventory turns ratio, then it does not necessarily mean that the firm is performing exceedingly well. It's just the nature of the industry that the firm is a part of. On the contrary, consider the case of real estate sector, wherein a property may take time to get sold. However, from the sale of a single property, high amount of revenue can be generated. Well, that's all for now. Thanks once again for tuning in.